Well, here we are, folks. And Brandon, you want to take the honors of introducing our famous guest.
We're here with Jason Weilee, who is an apartment investor and the director of investor relations for Rockstar Capital. And thank you for being here today.
Thank you so much for having me on.
Jason.
Jason came from H-Town.
He
reached out a couple weeks ago, said I'm going to be in LA. We said, that's it.
Could H-Town also be Huntington Beach? I was thinking, people think Huntington Beach.
I don't know. That might be a stretch.
Okay.
Yeah.
I didn't know what H-Town was when you first said it.
Rockstar Capital, Robert Martinez. What a honor it is, Jason, to have you here.
Thank you so much. Because you guys were in Houston. Was it a month ago or 2 months ago?
About a month ago.
Yep.
Yeah, about a month ago. Right. So we really enjoyed having you guys here. So excited to be here.
Yeah.
in LA, visiting you guys.
We'll talk about that day, Jason. But what an honor to meet you guys, your team, Robert Martinez. It was just fascinating. We learned a lot. Listen, I'm a little older than you guys, and I'm still learning new things. I don't know about you guys, but yeah.
Well, for those that are listening that don't know Rockstar Capital, haven't followed you guys yet, maybe what's the elevator pitch on that? What do you guys do? What are you guys known for?
Yeah, so Rockstar Capital, we are an independent owner kind of company. So we own and manage 4,600 units, mostly in the Houston market.
By the way, you guys heard that right, 4,600 apartment units these guys manage.
23 buildings.
Yes, 23 large apartment complexes, anywhere from 100 units or so to our biggest one is 458 units. So that one is a beast to manage.
Yeah.
Right, so we've been in business since 2011, and what's unique to us is that we truly are independent owner-operators. We tried third-party management for a few months, about 9 months or so. It didn't quite work out, and so especially with a lot of the market changes where it just requires you to be that much more proactive and hands-on to protect your valuation and just make sure you're cash flowing as much as possible. It does require you to have that level of control.
So when you guys, to jump in real quick, so when you guys say that you're owner operators, so it means like in the space, some real estate investors will buy an apartment building and they'll hire a third-party property manager,
Correct.
right? So that they're kind of the ones on the ground level. They're collecting the rents, running all the maintenance requests and things like that.
Right.
You guys, owning this 4,600 unit portfolio, you guys manage everything in-house. So you got a team of maintenance people, team of on-site and off-site property managers, asset managers, and you guys are getting up every day and pushing to make sure that you guys deliver great customer service, great community, for the tenants to be in.
Absolutely. There's no other, people that we can rely on to care about our properties and care about our assets the way we do, because we're investors in our properties too. Like Robert Martinez, he's the founder and CEO, so he invests his capital alongside all of our investors in each of our deals. I've invested in our deals, my family's invested in our deals, so it's very personal, right? So we just want to make sure we're protecting our investors' money, our family's money, and so it's very important that we be hands-on.
By the way, just real quick, I want to add, how much investor capital have you guys raised for the 4,600 units?
Yeah, so we've raised over 190 million from retail investors, and what that means is just everyday, regular people, not any kind of big institutions, just regular investors that contributed, 50,000 to 100,000 or more in those increments. And so
when you do your raise, Jason, is it a 506C or a 506B?
So we've done a combination for smaller raises. It'll be a 506B where we're pretty confident, where we don't need to do any kind of advertising on social media or to the general public. We can just do it from our own investor database. But for larger properties that are more expensive, that require more capital, then we will do a 506C because it requires us.
For those listening, 506B, as you could probably surmise here, is it's what they call a friends and family raise. So if you're doing a 506B, you're not allowed to advertise, but you can have what's called non-accredited investors. So people that make any amount of income, worth any amount of net worth, and they can put $25,000 in your deal, $10,000 in a deal, whatever you set the minimum at. When you advertise, the SEC basically says, hey, you're going out to the public, to strangers, so you can only work with high net worth individuals. or really people that, in their definition, make $200,000 to $300,000 a year or have at least $1 million net worth.
Yeah.
And so it's interesting because when you raise money, you're always kind of at the start of a deal going, all right, can I get this done with my existing network, or do I have to start advertising, right? And it's kind of what you touched on, like making those decisions.
Yeah.
Yeah, so it does come to like the aspects of the deal, how large of a raise are you looking at, how what's the kind of financing that you feel you can put on the deal. The more financing proceeds you can get, the smaller equity amount that's required. So those are all things to consider. Yeah.
Have you guys raised a lot of that money over social media that you guys were raising?
For sure. So like with Robert, he always talks about like the first 90 million that he raised was pretty much within an investor club that he was part of. That's how he learned about multifamily and learned about partner investing. And so that's how he got his first kind of batch of equity. But then the other batch, like the second half, was through social media. Just him building a personal brand, having a success and track record with his previous deals and being able to showcase that. So I think it's great what you guys are doing with this podcast, with everything you're doing to showcase, your deals and just everything you're doing. Because for regular investors, they don't look at this a lot, but when they do see people who are serious about this, who are putting out content, who are showing actually what's happening, everything that's going on behind the scenes of the deal, how the deal actually gets to fruition, to the closing table, those are all valuable things that investors appreciate, right? That level of transparency. So that's something that we do.
So how do you, if you guys have raised almost $200 million in private capital from investors, how do you guys not have constant calls from people wanting to know what's going on with this, what's going on with that, how's my money looking? I mean, we sort of touched on this earlier, right? But it seems like it'd be a lot of investors to constantly have to update. People are worried about their money. Here, the deal's going well.
Who's taking those calls, Jason? Like, who's talking to you?
I have a feeling Jason is, but I think he has a lot of
the majority of the calls, are me, right? When it comes time to address any kind of concerns or questions from investors, I'm going to be the one taking those calls for the most part. Robert will hop on if needed. And previously, when we were doing more acquisitions, we did have a small team of investor relations associates as well. But now that we are more focusing on just our management and getting our properties and portfolio stabilized so that we can be in acquisition mode again, we will start growing out that team again. But to answer your question, a lot of times when you are, again, transparent and just proactively addressing what is happening with the portfolio on a consistent basis, a lot of times there won't be a lot of questions because the investors are already getting that level of communication and already understanding what's happening. So it's super important to be transparent, to share the good, the bad, the ugly, and that way you're bringing the investors on this journey with you because they truly are partners. In a lot of cases they're called limited partners, but they're still partners, right? And as partners, they deserve to know what's happening with the business, what's happening with the investment, even though they've deferred a lot of the main decision making to you as the general partner, the manager of the deal. It's important that you still communicate exactly what's happening. And so when it does come time where maybe you need their help with some additional capital or with other resources you need from them, they're much more easily to get on board because they've understood and seen this whole.
With them.
How often do you guys do that? Do you actually send out updates or jump on a Zoom call, or what do you guys do? What's the process like?
Yeah, so we do a monthly investor webinar. That's for our entire portfolio. So anybody who's an investor with us, they're welcome to join in and just hear about what's happening. We do a lot of things portfolio-wide that are good for everybody's individual investments. Different contracts that we're negotiating to lower costs, portfolio insurance, right? All of these things are applicable for, everybody's individual deals, but we do mention it as a portfolio. But for us, we actually do go one by one for each of our 23 deals as well.
You do, on this
call. Calls. Yeah, and just give like a really...
Do you take questions too, Jason?
Oh, yeah,
I feel like this is going to be a long call.
Yeah, but again, we're very good at just consolidating everything into like the highlights, into the main things that an investor would want to know, that we would want to know if we were, a past investor in a deal. And a lot of it is just about, for investors, mostly they're just wanting to know, like, is my property cash flowing? Am I expecting a distribution, right? If you can answer those questions confidently and in a way that they like, you probably aren't going to get too many others.
Right.
It's for the deals that do require some more work. Maybe they're not in the ideal position because of market challenges or with different things just happening in that submarket. Because for a lot of our newer deals, we've seen a lot of supply come into the area where it's making it more difficult to lease when you have these new developments popping up left and right. And this is more for Class A properties like the new builds, where they're offering crazy concessions, 6 weeks free rent. They're offering $1,500 gift cards.
Right. Really
like
trying everything to get them in.
Exactly, because they need to lease up from zero, right? Where for
yeah.
us, we're trying to maintain occupancy. So those are just things, we have to be creative on. So for us, a lot of it is just trying to renew as much as possible. Any kind of upcoming lease expirations, we want to get those people onto a renewed agreement as quickly as possible, so that we're not having.
And you stay in touch with these tenants before their lease renewals, and reach out to them and offer them any type of incentive to renew, or
absolutely
you do.
Yeah. So depending on where we are in the season, sometimes we may do just a $0 renewal increase, or in some cases, and we have done in the past, even like a renewal concession, where they even have maybe a one-time concession.
Sign a new lease, we'll give you 2 weeks free rent.
Exactly.
Or we'll do something.
Because for us, and this is something that Robert talks about all the time, like your main costs in multifamily that are going to decrease your net operating income, decrease valuation, is with turnover, right? Is when you need to actually get a unit ready again for a new resident to move in, because you have to spend money to get the unit ready again. You need to do touch-up paint. You need to resurface.
You got to find the right tenant.
What's his expression? You guys, you make your money on the renewal, not the move-in. Is that? I mean, more or less, it's like based on what you're saying. If a unit goes vacant, so someone moves out, as a landlord, first of all, you might carry it vacant for a month, or whatever that average timeline is. So you've lost that rent. You're gonna have to put anywhere from $1,000 to $2,000, probably typical, maybe sometimes $3,000, into doing what's called make ready. You got to paint it and redo the carpet or whatever, however it's set up. So you're losing some income. You're having to put some money into it, and then you finally get someone in. Maybe even if you can raise the rent by $100, but that extra $1,200 a year just got eaten up pretty fast. So you really do. Make your money when you renew. Now, the caveat is, like at some of our properties, we've had tenants that have been there for a long time that are paying $600 or something, and the market rent's closer to $2,000. Listen, we love our tenants, but we're actually hoping maybe that person finds somewhere else to go, and so we can fix it up and we can raise the rent, because that's a pretty big delta. But if you're anywhere close to market, it doesn't make sense to not be aggressive to get people to stay.
Exactly.
Because it's just dead money that's out the window at that point.
Right. Yeah, because we've calculated like our average turn cost is about $4,000.
Is that taking into consideration effective like what you're losing on the loss of rent? Or is that just the money that goes in to make it ready?
Well, yeah, that's actually more just the actual make-ready costs, commission costs, everything that we actually need to spend. So it's not even accounting for vacancy.
So there you go. Because if you're eating $4,000 every time someone moves out, and then plus you got to carry it, $1,500 apartment or something for a month, you really lost $5,500.
Exactly. So again, sometimes it does make sense to just incentivize those renewals, but in other cases when you are far below market and there is a value add opportunity there, then yes, you actually do want to turn that rent roll over to bring in hopefully a higher paying, higher quality resident as well. So that's usually what we do when we're buying new deals, where we see there's a value add potential where rents are significantly below market.
Real quick, what's the portfolio value you guys are managing? So you have 4,600 units that you guys own and operate, right? You've raised about 190 million plus or minus dollars of actual capital to go into those. What's the total value? Is it $600-700 million or something like that?
Estimation would be about $600 million in assets under management.
So you guys are running 600. That's big.
$500 million.
$600 million portfolio.
Just say $500 million, Jason.
Yeah, half a billion. You need a hat that says that or something.
Well, I was gonna say I'm like super impressed with Jason and his team, Robert Martinez and his team, and Jason, it seems like he's the second-hand man. I'm telling you, he's got
to be in the top three.
Yeah,
that's
no diss to Alex, but Alex is one of their team members too. But Jason, well, I was gonna say super impressive because we went out in the field, we rolled through some of the properties that they own, and going back to what you're saying, you're bringing management in, and you can. It's a control thing because when you roll up on your property, like. You don't see a bunch of stuff on the balconies, and you don't see a bunch of stuff laid out over the property and stuff. It's very clean and very, it's just a very nice, I can tell you guys take pride in doing that. And again, that's the control that you have by doing everything yourselves, but with a good team. You guys have an amazing team. Jason.
Well, and by the way, I just want to jump in there before you zoom out, and then let's talk about the event. Is that Jason and I have been talking for maybe a year? I don't know if it is. It's got to be about a year.
More than a year,
right? And we met. I believe it was on social media. No, or am I missing? It was somewhere else?
Yeah, I think you were just following Robert's Instagram or something,
100%.
and you just
and then Jason, we messaged me, whatever. We started talking, and the thing I love about Jason is this guy does not stop with his follow-up, man. He is the follow-up king because.
And I don't think Jason ever raises his voice. He's got this one tone.
Yeah,
he's very.
He might be thinking I was Brandon guy, but he doesn't say it, so it's great. No, but no, the thing about you is like you and I talked a couple of times. We wanted to get to your guys' event. Timing wasn't right.
Yeah.
I think we missed 2 or 3 of them that you guys were having. And it would have been easy for you to be like, this guy out here in California is not really serious. I'm not going to keep following up with them. But you kept following up. And we made it happen, man. You got us out to Houston, and
you made it happen.
We're going to jump into it here.
Yeah.
But thank you. But I mean, but we made it happen because I might have not been thinking about it, out of sight, out of mind. And you kept pushing, like, hey, Brandon, you guys are trying to build your portfolio. You're trying to, grow your guys' team. You got to get out here and see what we're doing. We're gonna work with you guys for a couple of days.
And then remember, we were going to go out there, and something happened with the event, and Jason and his team had us come in,
anyway.
and we had a real personal, one-on-one with Robert and his team. It was actually better.
It was, and just the whole thing, being there for a couple of days with you guys, seeing your office, sitting in on real meetings. You guys were very transparent with us and sharing with us tools that we're now using every week. Now we're doing with our team a weekly accountability call, performance call. It's the same thing you guys do, and we're using the same format you gave us, the Excel sheet and everything you guys had built out. And it was just really cool that you guys were very it wasn't like some upsell thing. Sometimes you go to people's events or you sit down with them to get some mentorship, and then it's like, here's what I'm doing, but if you want to do this or that, cha-ching. But with you and Robert, I mean, it was just, hey, what can I do for you? What are you guys BCGK doing right now in your business, and what are the problems you're trying to solve? And I mean, our big takeaway, we had a couple big takeaways, but one was start focusing geographically, which was something we weren't really thinking of before we went there. It was a big eye opener.
It's you can scale to all the benefits that brings. It's tremendous idea, but I just think you have a good team, good synergy, and we're hoping to get there someday. But
that's awesome. They got another event coming up. So what do you guys got coming up in January, right?
Yeah, so we have another 3-day in-person mastermind, and it's going to be at our office because we do like to have that experience available where you're able to actually kind of see what you guys experience behind the scenes as to exactly what we're doing to run our portfolio. You'll meet our team members. You'll just really kind of get a good feel of everything that happens to make our deals work. And then on the 3rd day, we actually do a bus tour where we're going to visit a lot of our properties and just do some case studies.
Some Texas barbecue.
Yeah, there's some good food as well.
Yeah.
Tex-Mex, Texas barbecue, right? And the whole purpose really is just to kind of give you that window into what it can be like if you are wanting to scale up into a larger portfolio.
Yeah.
And the purpose behind it really is to help those who are actually serious about wanting to do this. And there's multiple ways to build your own portfolio, to run a portfolio. We're not saying our way is the only way to do it. We just want to share the things that have worked for us, and that way you can use it, develop it into your own. And I love how you guys immediately implemented different things to work for your business, because we want to see more of that. Because especially right now with how things are, it's much more important for you to have that operational know-how to make sure that regardless of who is doing the actual day-to-day managing of your deals, you still have full oversight over that, and you can make the changes when needed as an owner to protect your assets.
As opposed to not being, right, 100%.
Mm-hmm.
Well, I love that you guys, and Robert specifically, shout out to Robert. Thank you, man, for everything you've done so far for us.
We're going to keep Jason here,
Robert. Robert, sorry. This is the end of you and Jason. So, no, but no, the thing is I love that Robert, he walks the walk, right? Again, there's so many people in social media, the day and age of conferences and internet gurus, right? It's the good and the bad of social media.
Right.
And the other side of it is there's so many people that get out there and they want to run these courses and classes and let me teach how to do this and teach how to do and they don't really do it themselves, right? Robert owns almost 5,000, half a billion. You guys have 5,000 almost apartments, And yeah, the coaching might be this much of your business, and I appreciate that, because it's not like, it feels genuine that way, and I know it's genuine, because it's not just like, oh, I just need to get as many coaching students as I can. This, like, it's your primary business is going out there and walking the walk, and that's such a cool thing.
Yeah. Right. Yeah. Because that's who we've learned the best from as well. Like, again, Robert, he got his start, I don't know, 15 years ago when he knew nothing about real estate, and he did it within a club where it was people actually doing deals and learning that way versus, just learning from someone who's teaching a course, because there's just so many of that, like you said, nowadays. So who you learn from is I think nowadays so much more important than what you're learning or where you're learning it. It's like who is that behind teaching you things that you're trying to emulate, because ultimately I believe like the goal of learning from anybody is to kind of master their approach, like really understand why they do things a certain way and be able to, emulate that. And then after that, you can develop that into your own way of doing things.
Right.
Yeah, but really first understand what they're doing, why they're doing it, how they're doing it. And once you master that, then you can make it your own. Yeah.
Well, I think it's like anything else. It's the human nature. And what's the Roger Bannister? Did you guys know that name?
The 4-minute mile.
The 4-minute mile. Never been broken before. I think this is, when did he break it? It was this 1960, 1950, 50s, I want to say.
Really?
Yeah.
Wow.
But no one had ever broken it, right?
Wow.
And so he finally breaks it this one day.
Yeah.
And once he does, unbelievably, like within a month, someone else breaks it, or a couple months or whatever. But it was like, you could say within the next year, all of a sudden, like 10 runners had done it, right?
Really?
But it just went to the power of the human brain. Like, when you think something's impossible, or it's like it can't be done, it might not be able to be done, right? But as soon as you see, like, oh, he's doing it, and this actually is possible, like I can do it, now all of a sudden you're pushing through the barriers. It's just a weird.
It's like that rock climbing. You know that guy, Alex, I can't think of his last name, but he
like
free solos.
Yes.
And
Talk about some balls.
5-10 guys
Goddamn.
before him did it, and they took 2 days or whatever. Here goes this Alex guy. I think he did it in 3 hours or something without ropes and stuff. But yeah, I mean, like, you're right though. The ceiling is here. Somebody hits it, and then you're like, well, I'm just like him. I can do it. And so I agree.
That's the power of mentorship to me. It's having somebody sort of open the door and go, no, this is possible. Take a look around. And you're like, wow, shit.
Yeah, absolutely.
For sure.
What do you think the hardest part of being a landlord at that scale is? Having 4,600 tenants, essentially, hoping you guys, keep their communities running nicely every day.
Yeah. So for sure, the hardest part is just being able to attract and keep the right people that are able to hold your standards. And
you guys had a lot of turnover, or had to get rid of people?
And replicate. Oh yeah, for sure. And I think any good company is going to want to have the right level of turnover to, again, make sure that ultimately the right people are sitting in the right chairs.
Yeah.
Because Robert says it all the time. It's really the manager who's actually sitting in that chair day to day, who's running a multi-million-dollar business, multi-million-dollar
investment. But the
investment.
communication has to be good too.
Exactly.
Like, it has to be good. And you guys have a process in place that kind of helps that.
Right.
KPIs that you measure. But yeah, communication.
Yeah, for sure. Like we try to be as objective as possible and just really communicate how important it is to do things a certain way, because we know it produces the result that we're looking for, right? And that's why we do have like a weekly managers meeting with all of our on-site managers for them to hear directly from Robert, from the leadership team, as to what we need to see happen across the portfolio, so that it's not a question of why aren't you doing this, why have you done things this way? It's because we've already communicated it beforehand, and so that way when the standards are very clear, if someone truly is still not able to perform, then it's it's a very clear decision as to
really important.
Then they're just not a good fit, and we need somebody else to be in this chair, because again, at the end of the day, it's our investors' money that we got to protect.
Yeah,
so,
people have trusted you guys with $200 million of their hard-earned cash.
Yes.
So you guys have to be a little tough sometimes.
Yeah.
You got Johnny or Jill or whoever, or Bill, Johnny or Jill or Bill in the seat, and they shouldn't be in that seat.
Yeah.
You got to make a move, because
Right.
that's what people are expecting.
You guys are successful. I mean, you guys are doing it right. So your investors.
You guys have won a number of awards, right? Like one of the top operators in Houston for a number of years in a row.
Like Robert, I believe he's still the only person to have won the Independent Owner of the Year at the national level, the National Apartment Association Independent of the Year twice. I think he's the only person to have done it so far. And then Rockstar Capital, as a company, we've won like 19 city, state, and national apartment association awards. So
What do you attribute that to?
well, for one, Robert just likes winning, so I think that's that's part of the culture, right? You need to enjoy winning and want to do what it takes to win, because a lot of the bigger management companies that we've seen, they actually don't have the same amount of awards, level of awards, because for them that's not a priority, right? It's not something that for them they want to incentivize or encourage. But for us, like, awards are something that the team can take pride in, right? Because it's not just the company, winning that award. It's this team, right? It's the manager, it's their maintenance team that helped get the property in position to qualify for that award. And so for us, we incentivize that, financially as well. Like, we've given bonuses for teams and managers that have won awards, because for us, that's like a standard that no one can deny, right? When you have a physical award, when it's an award that's recognized by the industry community, these apartment associations, whether it be the city or national or state level, it's something that anybody can turn to and have this kind of objective standing of, like, this is proof, right, that you've done a good job. You've held your property to a level of standard that other people can respect.
Trophy.
Right.
Wow.
Exactly.
Wow.
Right.
One of the things I want to talk about is, so you guys, first of all, let me back up. What's your typical model been with investors? You guys pay out quarterly, you pay out monthly? How do you guys do that part of things?
Yeah, so typically it's been quarterly distributions, and for the majority of our deals so far, it's been communicated in the PPM, the private placement memorandum, that it'll be like a 7 to 10 year hold. Some of them have been shorter if we have found like a good exit opportunity within that time frame. But for the majority, we do want to communicate to our investors that this is meant to be a long-term investment.
Right.
Real estate is not something that you can just easily liquidate, get in and out, right?
These are large complexes, like you said, 100 to 400 doors. You're not just flipping a house. So someone comes in, they give you guys $100,000. They're expecting, if you're doing the distributions every 90 days, to get a little typically coming in.
Yeah.
And then they're going to be in this deal for, like you said, maybe 6, 7, 8 years or whatever the timeline is.
Right.
You guys are going to sell it, return the capital plus their profit. Is that, more or less, that's kind of the high level?
Yeah, and if it is sort of our standard model that we've been able to do in the past, they should be able to expect anywhere from a 2 to 3x equity multiple on their money in that.
And they've gotten the quarterly drip all along the way.
Yeah, they get the quarterly drip. The other big thing is the depreciation, right? That's a big thing to help. A lot of investors who have ordinary income, they want to offset, like that depreciation really helps.
Is that different in Texas then, or no, national? Because you have to be a real estate professional to get the full.
Yeah, depending on your real estate professional status or not, there's different levels of tax benefits and advantages you can take. But like for a lot of our deals in the past, even though it's a 7 to 10 year hold, sort of in that halfway mark, years 3 to 5, we would do a cash out refinance. Right. And we've done 1,500% cash out refinances. So
1,500%
just through those refinance events alone, the investors got their original investment amount back to them, in many cases even a little bit more.
And they're still in at the same level.
And they're still in the deal. They still have their same ownership percentage, sharing
but
ratio.
The quarterly drip would change depending on.
Yeah, it may change a little just depending on the level of financing, applied, and then what the cash flow is going to look like. Right, but from like an investment standpoint, like technically they're, it's an infinite return, right? As long as we
once
keep
you've gotten your money
holding
back,
the
everything else now it's the house's money. Basically.
Yeah, it's all gravy, right? Until we sell, and Robert has done deals where he's actually refinanced multiple times, like the same deal 2 or 3 times, and so each of those, right, big paydays. But then the final big payday is upon an exit, right? That's when you can get another large chunk of your investment amount back to you.
Well, the reason I wanted to ask about the model is because I know because we've got a chance to get out there to Houston and talk to you guys. So you guys had some deals over this past year and a half maybe when interest rates started going crazy.
Right.
A lot of investors were having some problems, and a lot of investors were losing buildings and having like some real big problems, right? But you guys had some properties, maybe a big portion of the portfolio, where you had to basically go to your investors and say, hey, good news, bad news. Good news is we still have the properties. We're in no jeopardy of losing them, quote unquote.
Right.
Tenants are there. But the bad news is because the interest rates have spiked up so high, our mortgage payments have gone up. and we can't pay the distributions right now.
Right.
But if you guys have some patience and let us work through this thing, we're going to turn the properties around financially as far as be able to refinance. I mean, walk us through that, because to me it's, everybody talks about the good things, right? Like we've been talking about, right? You've built this beautiful portfolio, you've gotten all these awards, but you guys have also, let's be honest, from what I understand, maybe Robert would agree, you guys have had kind of a hard time in the last 18 months as far as with some of your properties, right?
Yeah.
Because you guys bought these properties with, use a random number, you buy a property and the mortgage payment's $50,000, right, a month? It's called $50,000,
What
right?
LTV though do you normally buy them at?
I thought mortgage payments didn't change.
Well, okay, so let's go. Yeah. So what happens is in the multifamily space, it's not like residential. So residential, you buy a house, it's usually a 30-year fixed, right? Yeah, there's some loans that are 10 years, 5 years, whatever. But in the commercial multifamily, these big deals, a lot of times you buy these properties with what's called bridge debt. And it's basically a way of saying like, hey, I'm going to come in, I'm going to fix this thing up, and I'm going to want to refinance it in a year or 2 or 3 anyway. So I'm going to come in with more of a short-term loan that has a variable interest rate. And what happens is, when the rates are low, that's a great loan program to have. But with what just happened recently, where rates shot up almost overnight, a lot of these big commercial investors had these properties where maybe a mortgage payment was $50,000 to use some random number, and it shot up to $150,000 almost overnight. So now even if that property was making money, all of a sudden it's upside down where every month you're having to pay into it.
Yeah.
And so that starts hurting really fast, right? Because if you own 23 properties or 4,600 doors, and you have a big portion of your portfolio where your mortgage payments are shot up because you can't now refinance quickly off that, there's an issue.
Yeah.
And so a lot of people lost their properties. There was, there were some things going on, right?
But the key objective would be to refinance that property and put it on more of a longer-term stability program.
Right. And
Like
see,
a 5-year or a 7-year.
That's
fixed term.
fixed.
And see,
Yeah,
but here's the challenge, right? Because let's say you had a building, and these are big buildings, right? So let's say the building's worth $30 million. We'll use that as an example. And then all of a sudden rates went through the roof. And so what was happening is because rates went up, that was compressing the value a little bit, if that makes sense. Because now rates have gone up, so the next buyer is going to pay less for that same property because it's an income property.
Okay.
And so the point is that function of the rates going up not only sent your mortgage payment up, but now your property is not worth 30, it's maybe worth 25. Or whatever the number is. So now you go to the bank and say, can you please refinance me? And they go, I don't know. The rates are higher, and we're not really comfortable with the loan market at the moment. Plus, your property's worth $5 million less than it was last year.
So you're underwater.
There you
Well,
go. Now, here's the thing, right? Because of the types of properties that they are, again, as long as you can hold them long enough, you'll get out the other side, right? I mean, you're getting the rents every month. But there's also only so long that you can go and feed the beast and have negative cash flow.
Right.
And so, and I'll let you finish the story there, but from what I've seen from these guys, they kind of got into a position where they had some of these bad loans, and these are big loans, and Robert and the team, just got in there and they did what they did, right? You guys started drilling down to operations. You said, we're gonna increase the NOI, we're gonna figure out how to buy some time and refinance these things, and talk us through some of that fight, because I know you guys are coming out of the other side of it now, which is awesome.
Yeah, for sure. Because this isn't something that was unique to us. This
Right.
was across the
Industry-wide.
country, probably even different parts of the world as well, where they have they felt those effects of the rates just kind of skyrocketing, like you said, almost overnight. And we've shown this to our investors as well, where we looked at graphs of how quickly the Fed would increase rates historically, and over the past 18-24 months, it was probably the steepest rate hike they've done
Ever.
because it was manipulated as well. It wasn't in response to any kind of true economic condition. The Fed just decided that they wanted to force rates up, and so everybody had to adjust to that. It's almost like if you had a car payment where you were paying, 2%, 3%, and then overnight now you have to pay 7%, 8%. Like that's a big constraint, right?
Yeah.
And so unfortunately, lenders aren't going to just want to modify your loan immediately. They just tell you gotta figure something out, right? So that's what we were tasked to do. And I think you mentioned something that I think maybe the audience needs to be aware of, or if you're not familiar with multifamily investing, the valuation of your property is determined by something called NOI, which is your net operating income, and then a cap rate. So a cap rate is just the expected rate of return if you purchase this property all in cash. It's unlevered return, right? So cap rates and interest rates are usually hand in hand. When interest rates go up, your cap rates go up as well. And so when your cap rates go up, your valuation goes down. And so that is exactly what you were describing, what was happening, where we did everything right. We operated well. We're really great operators. But when the market shifts, when interest rates go up, when cap rates go up, we get an automatic reduction in valuation. And at the same time, lenders, now that the market has also shifted and they're being a little bit more conservative and just holding tighter onto their money because they've seen deals go south with other types of investments, especially in commercial office space, right? Because we all know sort of how that industry was affected by the pandemic and everything. So lenders are just being more conservative. They're underwriting at lower LTVs, right? They're not willing to loan you as much money compared to what they believe the value of your property is, right? That ratio is reduced. And at the same time, they are underwriting at higher debt service coverage constraints, right? Where before it would be very standard, as long as your property can meet 1.25 times the debt service each month, then you're good. Like they're willing to loan you an amount where they feel comfortable that the property, with the NOI and a trajectory can meet that.
Where were they doing it?
Yeah, now it's 1.35.
right.
For the latest refinances that we've done, it's 1.3 to 1.35.
Which the summary goes back to what you just touched on. Is the
Exactly.
banks got more strict. So not only is the valuation coming down a little bit, the rates have gone up, the banks get a little more scared. So when you put that perfect storm together, again, now you've got this situation where you're like, oh, dang, my 50 grand mortgage payment on this property. And by the way, let's even just say that property was bringing in, round numbers, say it's bringing in $80,000 a month. Right. And your mortgage payment's 50. So you're clearing $30,000 a month, right? Going into the, whatever. But now all of a sudden that mortgage payment goes up to 150, like I said a second ago. You're so far, even some rent increases aren't going to get you out of that. So now you have to find a way to refinance. You got to find a way to pay that loan down a little bit, or refinance, however it's going to be.
Well, you guys experienced some of that.
Yeah, exactly. And we had two properties where the loans were actually maturing as well. So it was an even tighter kind of clock, ticking clock that we had, because we're in a position where we have to refinance. It doesn't matter, it's not a matter of when it's going to happen. It's like it has to happen, right? Like the lender is kind of knocking at our door saying that the loan is due, right? You need to find a way to pay off this loan. What is your plan for refinancing?
What was Robert's mindset when all this was happening? Because Robert, is sitting here going, man, I've had the golden touch, in my career since 2011. I get on the scene, I buy all these properties, almost 5,000 units, one of the biggest landlords in Houston. And to all of a sudden, like any person who's probably achieved some success and they start getting their ass kicked a little bit, they're like, whew, but how was it being in the office with them? I mean, I know he's a fighter. I know he gets up every day and says, F it, we're going to make it happen. But what was his mindset? What was he doing to keep his head on straight? Yeah,
so he's mentioned this a lot to our investors and just to a lot of people who've listened to his story where, he just had to wake up and adjust to a new reality because of what happened. He described it as maybe just waking up one day and the sky's not blue, water's not wet. You just have to adjust to this new reality and
Are we
figure
on
out
Mars? Yeah,
how to survive. It's like, where am I? It's like, what is this new world that I'm in? But there are solutions to everything, right? And so previously we were talking about refinances where in the past they were 100% cash out refinances, right? Where we're making money because the new loan is so much more than the old loan that we're paying off. We're able to keep a portion and actually distribute that back to our investors. And the amount distributed is non-taxable because these are loan dollars. So, it's a big, nice payday for the investors there. But in these cases, for the two refinances that we had to do where the loans were coming due, these actually were cash-in refinances.
Right. Because you guys had to put some money in.
Yes.
I don't want to say to stop the bleeding, but that's what it was. It was like, hey, this loan is so upside down that if we don't, use that example again, we're losing 50 grand a month or 100 grand a month, whatever the number is. So they're like, okay, we better just write $1 million check in now to get the new loan, and then the new loan will be positive. At least we stop the bleeding. We're not going backward.
The bank did their due diligence. They did their valuation, whatever, and they said, all right, here's your new loan. You need to bring in, $300,000. But do you go to the existing investors on that property first? Or?
So we did go to our existing investors, and because these were older deals, there wasn't a big equity raise in the first place, and so there was a very small investor pool for each of them. So asking them to put in anywhere from $1.5 to $2 million just within those initial investment groups just wasn't very feasible because A lot of them are,
Mom and pops.
a lot of investors aren't just invested in your deals, right? They're
Right.
invested in,
Right.
Sam's deals, Brandon's deals,
They
other
got
people's
money,
deals,
yeah.
right?
Everybody.
And guess what? Everybody's asking now for, for help with their deals because everybody's experiencing the situation where some of these loans are now out of whack. So some of the investors just were tapped out of liquidity as well. They just couldn't contribute additional funds to help, save the properties. So we had to get creative and find other ways to raise that capital. So for the first time, we raised what's called preferred equity. And so we set up a new tranche of investors within our operating agreement. So it was called,
On that particular property.
yes, for those two,
Properties.
because we raise capital on a deal-by-deal basis. We
Yeah.
don't have a general fund.
Right.
Every deal, we set up its own entity, and the investors are members of that entity.
Sure.
So we created a new class called Class P investors, P for preferred, and we just amended the operating agreement, and the original investors had to approve of it, and they did because it was kind of the only option we had, and they
Yeah.
understood the benefits that would come with this.
Yeah.
Is now with this new group of preferred investors, they're the ones bringing the capital needed to get this refinance done, and also to build some additional reserves that the properties needed. And then because of that, they are going to be rewarded with a preferred return, meaning that they are paid first when it comes to any kind of distributions made to the investment group. And so they're kind of cutting in line,
In front.
right, ahead
Yeah,
of the original
interesting.
investors.
Yeah.
But
to
again,
save the deal.
Yeah, to save the deal, right?
Yeah.
So it's,
Yeah.
it's
So a
either
little
that.
dilution on the old guys, but
Yeah, but they're still
But the
protecting
deal
their
gets
equity.
saved.
Yeah, the
Yeah.
deal is saved. We can still keep operating it, and we can still have a big return once we are planning to exit these deals in the next 24 months.
Well,
you are.
look, I think
Oh.
that's the whole thing, right? About this, what the bigger overarching theme is in business, you're going to have setbacks.
Yeah.
Doesn't matter who you are, you're going to have. I mean, unless you're okay just staying small. But in business, if you're really growing something, at some point you're gonna have some bumps. And I think what
Yeah.
you do when you go through those bumps, how you handle that experience, especially with your partners and your investors, that it says everything about not only your personality, but
Yeah.
about, should those people then do more business with you? Should they invest more with you, right?
Exactly. And
It-
a lot of
it's-
times these setbacks aren't, the result of you doing anything wrong.
Right.
Because we didn't do anything wrong.
Right,
It was
it's just market-
the market changed, right?
the
We
market
woke up in a
changed.
brand new world. It's
Yeah.
like
Yeah.
interest rates are now
hopefully that changes
skyrocketing.
back too. Jason.
Yeah. Taxes and insurance did the same thing, but hopefully we are entering into a
So assuming
better environment now.
we're going into the better environment, rates are coming down again. You guys
Right.
are getting everything worked out in your portfolio. When you already have $500 million or $600 million in assets, what's the next benchmark to get excited about? Is it $1 billion? Is it a couple $1 billion? Where do you guys see yourselves going? Is there a conscious number ahead on that one?
Yeah, I don't think there's any one specific number. Right now, the main priority is to get the last few deals that we still have on floating rate debt refinanced so that
Right.
we're on fixed debt for the whole portfolio. And the number one benchmark is to cash flow for the entire portfolio.
Right.
Because the ones that are still on floating rate debt, they're still not able to truly cash flow where we can pay out distributions because there's still so much uncertainty with the interest rate itself. Like we cannot in good faith pay out distributions when,
You don't know what the rate's going to do.
exactly. We don't know
Yeah.
what the rate's going to do. And especially if we're going to need to continue paying this higher than expected interest rate. So first priority is refinance. Second is to get every property in position to really cash flow. We're paying out distributions. And then
it's time to go find some
Yeah,
new properties,
and
huh?
then it's
Yeah,
It's time to go
find
buy.
some properties.
Yeah.
exactly.
Yeah.
I mean,
And then also strategically maybe either exit or find other cash out events for some of our older properties
course.
that has a lot of equity built up in these deals.
Right.
Because I think with a lot of investors, you do need to, educate them in that even if they're not seeing like a big drip in distributions, whether it be monthly or quarterly, if they are in great deals, there is a lot of equity that's
Right.
built into those deals.
Yeah.
So a lot of times investors don't see that because they're only looking at the distribution, but those big equity gains are realized, when it's a cash out refi or a sale. And so those are things that we're going to be considering as well. Because sometimes it does make sense to, like as we say, take the chips off the table because
Yeah.
you're able to redeploy that hopefully into a bigger, better asset.
Better deal.
what is
that
it
is
like
more
working
efficient.
with someone like Robert Martinez?
I really enjoy working with Robert because he is always kind of full steam ahead.
Yeah.
And sometimes he's not always, going to pay too much attention to like the details of things, but
Right.
that's where, the team is
That's why he
able
has a
to
good team, yeah.
help him with that, just to protect him as well and make sure we're protecting our investors' equity too when we're making these decisions. But a lot of times it does require someone who does have the courage to, do what is maybe not easy to do, right? When it comes time to like ask investors for additional capital, when he's never had to do that in his 15 years career. Like last year was the first time we've ever had to do any kind of capital call where we've had to come back to the investors and say, we actually need more money from you to continue
I feel like
protecting
Robert
this deal.
has certain things that he will, we're doing it this way, and he's probably right. And I think he acquiesces to you guys, the team members,
On certain things.
on certain other things. I think it's a good balance.
Yeah,
I
yeah.
think Robert does.
Well, and I think too, like it just made me think about that was a lot of people, we're kind of in the day and age where it's like everyone wants to be self-employed, the solopreneur,
Yeah.
is that what they
Sure.
call it? Yeah.
Mm-hmm. Yeah.
And there's nothing wrong with that. But at the same time, I think there's also a lot of benefit you can get from getting on a team, getting in a company with someone. I mean, you're one of the right-hand men. We were joking earlier, but you're like, one of the couple people that are in Robert Martinez's close circle, and he's built this $600 million empire that probably soon will definitely be $1 billion plus. And you get to work with him every single day and see how his brain works and be a part of this magical thing that he's building, that you guys are building. And I think it's cool. And I guess I would encourage people to, not be so fast to think you have to be, I got to be my own boss and I have to do my own thing. I'll never work for someone, because sometimes that's the route you should go, and more power to you, do it. But sometimes you can get farther ahead faster by getting on a team with someone who's already doing big things, and then I don't want to say drafting behind them, but getting that momentum of riding up and then deciding where it goes from there, right?
Yeah.
Versus trying to learn everything from yourself from
For
scratch.
sure.
The team matters. If you get on the wrong team,
Yeah,
you
well,
know
that
it
throws
can go
everything
down.
I just said out the window if it's the wrong team, yeah.
When you get on the right team, it's like the pieces are bigger than the pie, or the pie is big. It just has this synergy. So I think, and that's what I felt when I saw your team, Jason. You guys,
That's awesome.
just,
Yeah. We appreciate that, because again, it is ultimately just these people that you're going to be spending hours of your day with, probably more than with your own family.
Yeah.
And so you got to make sure
I experienced that with this guy.
Right,
I keep trying to get out of that, like put a wall up in our office. It's just like a little thing where I look through it and like, Greg, are you in there? But a little too close to comfort sometimes. But what are you gonna do?
But I feel like even like when you're with a team, when problems occur, or you're kind of up against it, at least it gets diffused a little bit between the members. You know what I mean? Like it's not just Jason. Your ass is on the line. No,
Right.
The team is there to back you.
Yeah, that's the power
That's the power.
Exactly, having a team, and that's why we also, invest in our education to learn from other people and be part of these masterminds. Right, that's the whole point. Like the solutions are already here. Like it's needing to put these minds together. Robert calls it brain share, where he's kind of just voicing his thoughts and opinions out loud to see what other thoughts that we can pick up as a team to problem solve together.
Yeah, and it's that whole coming from abundance. I know this is like a common theme.
We might have to change it to the abundance podcast or something.
High stakes abundance.
Yeah.
But abundance, like you just give without any expectations of return, but the return is just built into the giving.
Yes.
Like I'm telling you, the karma, whatever you want to call it, it just comes back to you tenfold, because you are just, you're sharing your experience and without any fear, and it's a really good thing. You come from abundance instead of, coming from, a little
Scarcity mindset.
Scarcity,
Yeah.
Right.
Hey, Corey, I know you just got an apartment recently, by the way.
Oh, I did. I have a whole
You got some
bunch of
questions?
apartment questions.
Dude,
Okay.
break it
I
down with some
have-
questions. I know we're getting to the tail
rattle
end. I don't
them
want to
off,
say,
Corey.
but
Come on.
I want to get Corey in here.
Jason's in the hot seat.
I have a couple questions. So what are the rents that in your apartment buildings? What do they range from?
Yeah, so we have apartment buildings of different we call classes, and so
And they're all in Houston.
they're all in Houston. Well, some of them are down in South
that's
Texas,
right.
Like Corpus
2 or 3,
Christi.
yeah.
So a Class C property, it could be anywhere from like $700 to $800 for like a one bed, but then our Class A's can be anywhere from $13 to $14, even $1,500 for for a 1-bedroom.
For a 1-bedroom.
Oh,
But that's
okay.
still pretty good for.
I was gonna say-
That's Houston.
I'm
though.
used to these LA prices.
Because
Yeah,
I used to live in
700 to
California.
1500. That's pretty good.
Right. I used to live in Cali for a little bit, and I paid like $2,100 for
Yeah.
for 1 bedroom.
Yeah,
right.
yeah.
Right. So it's depending on where you live as well.
Yeah.
Now, I've had a lot of apartments, and I've generally found that a lot of landlords, their goal is to like flip them, turn and burn them to raise the rent with the market rate.
Yeah.
But what you were explaining earlier sounded more like you want people to stay in
renewals.
units.
Oh
longer.
yes,
Jason,
especially if we're going to be more of a long-term hold investor. We want to reduce turnover as much as possible, because again, anytime we need to make a unit ready again, that's more costs that we have to spend. And again, with multifamily, your valuation is directly tied to your profitability of how well you can have more income than operating expenses, right? So we want to reduce those amount of operating expenses as we can.
And I
I
think
feel like that's the
also-
old school version of being a landlord. Like you got an apartment or you owned it and you have a mortgage and whatever the rent covered the mortgage, and that was the kind of the goal.
That was right.
There is more of a refinement to that, because when you're in business and owning an apartment building, like they were saying earlier, if the rents, Corey, are closer to what markets are, so if market's $1,200 and you're paying $1,100, your rent is $1,100. Market says $1,200 or $1,300. Would you be more apt to just, Corey, renew with me again and continue to pay your $1,100? You know what I mean? But if you're paying a lower rent,
Well, if it's $4,000 to flip a unit, that's
right.
that was an
That's a lot of
impressive-
money.
That's what
They
I'm saying.
Is that
it
what you-
makes more sense to keep you happy and in place.
Is that the number that you all see it cost to flip a unit?
Yeah, I mean that's a good number. I mean, I would say if it's something on the low end, it's 1,500. On the high end, it's probably $3,000 or $4,000. So yeah, I would agree with that,
Yeah.
even for us.
Yeah.
I left my unit because they raised the rent, and I didn't think
How
it was
much,
worth
Corey?
it.
How much did they raise it?
My rent was $1,899, and they were upping it to $2,080.
Okay.
2080,
Okay.
Yeah.
2080.
Couple $100.
Okay.
And for the amenities that just were not
Yeah,
there,
you-
and the nothing that was being
Right.
gained
Yeah.
from the
Yeah.
process,
You're like,
I said,
later.
Interesting, Corey.
goodbye.
Yeah, you did the
Yeah.
math and said it wasn't worth it.
Didn't make any
Yeah.
sense.
Yeah, so even if they got that $200 a month, that would make them $2,400 in a year.
Right.
The reality
Right.
is they probably take them 2 years to get that money back,
Right.
even including the loss of
'Cause
rent
you
and
left.
everything.
Right.
Yeah.
Exactly.
And in my mind, I was, and I knew I was above market, so I also I'm like, you all aren't even
Yeah.
gonna get what I was paying.
Yeah.
Well,
Once
let
this
me
goes
ask you a
back
question.
on.
Yeah.
What would it have taken for them to keep you? So once you said, no, I'm out, if somebody, because they have a care team, and we've started implementing a care team on our side, which is basically a team of people that try to save things, right?
Right.
And there's other things they do. But the point is, once you said to them, hey, I'm not going to do this, I'm out, I'm giving my notice, what would it have taken for someone to call and actually offer you for you to stay kind of thing?
Yeah.
Hold on one second. Wait 1 minute. We're still in a recording session. Whoever just opened the door. Thank you.
No. We're gonna lock that door.
I will lock the door.
Yeah.
Well, listen, we've had everything on these podcasts. We've had fire alarm went off one time.
Really?
Yeah.
Okay.
We've had all kinds of funny stuff.
Right.
But Chinzo was here. My son was here a couple podcasts ago, and his big old face within here, and we're like, Chinzo, chill. So yeah. Anyway.
The show
you
goes
would've-
on.
Yeah. But
Yeah.
you-
So what would it? Yeah, it was. So what would it have taken? Because I'm just curious from your point of view, if they would have called back and said, instead of $200, only $100 or $50, or I'll give you a new microwave, or I'll clean the unit, or give you 2 weeks free. What would have changed your mind to stay?
Yeah.
I guess they probably should have tried something.
They didn't try
probably-
anything.
They didn't try anything.
So okay.
Oh, okay,
so
that's
shame on them, man.
Yeah,
Oh, I was
Yeah.
pretty fucking
Yeah.
upset.
No one-
I was out when I
But-
it was a very quick decision.
But
that
Corey, if they would have tried something, it would have maybe have changed your mind.
it would have maybe changed my mind if I
Right.
had been if they had given me 2 weeks free, if they had, but I
Yeah.
mean just my,
Or just zero increase.
or
just
they should have
renew
left my
with
rent
me.
alone.
Yeah.
That's what
Yeah.
they should have done.
Yeah.
Because
Yeah.
Yes.
the building is in whatever condition it's in.
Yeah.
And
Right.
I, as a tenant, am pretty chill.
Right.
I don't call about this that needs to be fixed,
Right.
and this that needs to be fixed, and this that needs to be done. And so if you leave me alone,
You'll-
I will leave you alone.
Yes.
And you will get your rent on the first, and
Yeah.
everybody will be Gucci.
Yeah.
Yeah.
And that's how I
See,
like.
That's a lost.
You know.
That's a lost cause right there. You
Well,
know?
because so what and what these guys do, what we picked up from them is they've got this care team, and that's part of what they do, and that's part of how we've implemented on our side is now Greg's part of that team, and if somebody says I'm leaving, and the PM tells us on one of our Wednesday calls, hey, I can't save these 3 leases that are expiring.
We'll try and save them.
Greg will call him personally and say, hey, what can I do? Can we change something? Let me see if I can get you a concession. And we just rolled that out because when we went to meet with you guys, you had that care team that works on delinquencies, renewals, and whatever else they do. And we were like, damn, this is good, because it's almost like, how else you would describe it, but it's like, sometimes if you're used to dealing with one person, they're kind of a pain in the butt, but their manager or a supervisor or the owner calls and it's a friendly voice and like, hey, don't worry about Susie, she's doing her job. Yeah. How can we work this out? It takes the emotions out of it because sometimes, and maybe in your case, you didn't know, I don't know who you were dealing with, but a lot of times, they didn't even call anyway. So.
Yeah. Right.
Yeah.
Yeah, I mean, that's huge because sometimes it is small things or even just having, the resident feel like they're being heard and understood. That makes all the difference. Because we've offered free carpet cleaning, like a new stove if they were needing it, or like washers and dryers or things like that.
Yeah.
Because for us, that is like the benefit of being able to keep a happy resident in that unit far outweighs
$500 on a stove.
Right.
$500 on a stove instead of $4,000 on a turn. Right.
Exactly.
Yeah.
Right.
Yeah.
How interesting. Okay. How do you measure like success in like as is it acquiring more units? Is it the happiness? Is it the awards that you win? How do you all like measure success?
As a company at Rockstar?
You
or me?
Yeah.
Oh, personally.
Okay.
And I guess in whatever roles that like, because you must be influencing some people who work beneath you or whatever, you're influencing something. So like, how does your team measure success? Or how do you measure success as a boss?
Well, I'll start with me personally. So one of my favorite definitions of success that I've heard is success is the progressive realization of a worthy ideal. So success to me doesn't mean you have to achieve a certain result. It's, are you truly on that path? Are you on that journey? And do you know what your goal even is? And is it a worthy goal? Like if it's a worthy ideal and you're constantly making progress toward it and you can see yourself moving in that direction and the goal is moving in your direction too, I feel like that is success in itself. Yeah. And because you're going to keep going and you will attain that goal. It's not even a matter of question because you're on that path. It's like when that momentum starts, like you're going to hit that target. So like with all these refinances that we're doing right now, like we know it's going to happen. Like even though there are certain things that we have to deal with, just the nuances of getting all the, things dotted and crossed and finding out which option is going to work best. Like we're more than willing to go through that because we know it's going to happen.
It's a worthy goal.
Yeah, it's a worthy goal, and once we attain it, we can move on to the next thing.
Yeah, I like that.
So I think for Rockstar as a company, we measure success, based off of a lot of the objective things, as in like what is the return that we're able to produce for investors, what is the level of satisfaction we're having with our residents, and we can measure that with the number of renewals we're getting. So a lot of times it can be broken down into a number that you can measure. That is helpful, but then again, there are some of the intangible things that are a lot more impactful. Having a great review from a resident or a great testimonial from an investor where they're willing to kind of even fight for us on some of these investor calls where some of the newer investors are a little unhappy but are more legacy,
the
older
OG investors are like, no, these guys are solid.
Like, these guys are solid. Like Robert knows what he's doing.
Yeah,
Like
cool.
that's kind of priceless. Right?
Would you say there's a direct correlation between how satisfied a resident is and the return you guys get for your investors?
Oh, for sure. I mean, I think it's a direct correlation. Like if your
When
residents
you really water it down to its basic part, it's like take care of the tenants or the residents at the core level, and then you're gonna perform better.
Yeah.
Oh,
and you're
for
gonna make
sure.
more money for the investors.
Yeah, it's a direct correlation. Right.
So listen, I don't know how much longer we have.
I know we got to wrap soon.
Well, I just
Yeah.
kind of want to ask Jason. Jason's in town from Houston, and so you're going to Orange County a little bit later today. And
Yes, I'm going to a conference with a big name in the real estate business space. It's going to be my first time. I'm going to be on stage for a little
He's
bit
actually
as well.
it's gonna be interviewed on stage in front of a bunch of people.
Jason's going places.
How many
He's in
people-
LA
how many
doing
people are
LA
gonna be there, do you
things.
think?
I think they were saying either like 5,000 or something like that. It's a big conference.
Yeah.
So
Okay, that's a lot of people.
That's awesome,
Yeah.
man.
So
That's
I
cool,
mean,
Jason.
I think at the end of the day, like those are nice, but I really enjoy these
Of course.
types of
Well,
setups, right?
Jason,
When you get
you
to
know,
really,
that.
Listen,
Yeah.
we really
Next time we
enjoy-
interview you, we'll have 5,000 people in the audience.
5,000 in the audience. Right.
Corey, get us 5,000.
Right.
We'll be there too.
Right.
No,
But
well,
I
you
mean-
guys probably have 5,000 views, right? Those are real people, right?
We might need to boost it a little bit, but yeah, close.
It's always a pleasure to talk with you, Jason, and to have you. I mean, I feel like we're new friends, old friends. You'll be old friend soon, But yeah, when you come back out to Los Angeles, we're definitely gonna see you again.
Don't think we're not going to pop in on you in Houston. We're coming in January.
Oh, yeah.
So
You guys
That's
are
right.
coming back, back down to
I was going to
H-Town.
say on that point, so how do people get in touch with you, and how do people, if they want to come, so any other people that are interested in investing in real estate, networking, want to start building a multifamily portfolio, how do they go to the Rockstar event in January? Let's plug that real quick.
Yeah, so for the 3-day event in January, it's the 15th through the 17th, January 15th through the 17th, 2025, and you can go to rockstar-mastermind.com, and you'll find all the info there. And anyone who's interested in investing, it's rockstar-capital.com, capital.com, and you'll find all of our info there, how to kind of get connected with us and potentially partner with us.
Boom. You heard it here, guys. Well,
Awesome.
that's another episode of the high stakes deals, and it doesn't get a lot more high stakes
No.
than Rockstar
Yeah,
Capital
I think
and
we've,
Jason and his team. So
yeah.
no, we're super appreciative you came on, and bam,
Yes.
give me one of those.
Thank you so much.
Thank you,
We'll
Jason.
shake hands.
Yeah.
It's like,
Yeah, yeah.
No
"Boss,
shake
I
for
got
you."
my way.